You are listening to chartingwealth.com for Wednesday, the 22nd of February, 2017. Let's jump right into these markets we saw for the day. Stocks were up, gold was up, bonds down just a little bit. Let's jump into the S&P 500 as depicted by SPY. We see lots and lots of movement since our two-day crossover occurred back on the 10th of February. In fact, when we look all the way back, we see that our weekly crossover occurred back on the week ending, around the 25th of November. And we saw the market move up quite a bit, slide sideways, and then start shooting up lately. When we look at our 2-hour chart, what do we see? Well, we saw a jumping in point. Actually, that jumping in point occurred at about noon over the course of the day on Tuesday. The jumping in point would have been on the opening at $235.17 on the S&P 500. By the end of the day, the high was $237.88, and we continue to watch as that market continues to accelerate upward. We see on that 2-hour chart a real acceleration in the derivative oscillator, and we also see toward the end of the day a peaking up of the PPO, the price percent oscillator, which is of course our king of the oscillators that we use, very similar to the MACD. We use it because of the way that it uses percentages instead of an absolute. So over time, it works better and is much more effective than the MACD. You can compare it also across the board. You can compare a stock with an index much more accurately than using the MACD. That's why we use it. You want to read more about it. Of course, you can find a training on our website, and you can also just Google it. It is a great oscillator, and we very much like using it. Now let's keep moving through these charts because we only have 10 minutes. That's all we ask you to spend with us every day. What do we have going on the Qs? Up 0.49% for the day. Of course, our jumping in point, we had two of them. One was the weekly jumping in point on the Qs. That was when the weekly vertical crossover occurred at the week ending the 6th of January. And of course, we have seen the market continue to accelerate up past that point. And of course, we also had another jumping in point. And we will go to our 2-hour chart, and we can find that all the way back on the 1st of February. That's when our 2-hour chart crossed over, and you would have jumped in again on the opening on the 2 at 4 o'clock or so, or you could have actually done so the next morning. The opening around 125 is where you would have gotten in. Where did it end today? After a few short weeks, not even the entire month of February. What do we see? 130.11, folks. The high was 130.53. That is a nice $5 plus increase over just 2.5 weeks. So we love the way that our charts work when they work. And do they always work? No. Anybody who tells you they do is a liar and is trying to sell you something you ought not to be buying. What do? We trend follow. We do not forecast. You can't forecast the market. The best you can do is find an established trend and ride it. That's what we try to do, and we try to reduce our risk as much as possible. The first key to doing well in the market is not to lose money. The second key to doing well in the market is to make money. But if you lose a lot of money, you got to make a whole lot more, and that is much, much harder to do as that nest egg shrinks. So we're very happy we're continuing to watch the Qs go up, up, and up. And again, we'll just continue to ride this pony as long as it goes. We can see there was a crossover going down on the 2-hour chart back on the 17th. Of course, it crossed back over on the morning of the 21st. Again, we had an extended weekend because the market was closed on Monday for President's Day. But like we talked about toward the end of the last week, Depending on how you wish to trade, it is important to look at both the short and the long charts. When your 2-day chart continues to build and continues to go up, even though you can have a downturn in the shorter chart like the 2-hour chart, you can always look back for reassurance to both the 2-day, that is the longer chart, and the longest chart, which is of course our weekly, which continues to move up strongly. So again, we have no divergences. We have higher highs on our PPO and on our price movement, and we just continue to see things go up. How long will they go up? Until they don't go up anymore. That's where we want to get out of this trade, or whenever you have sufficient profits. Again, you don't have to get every single penny. You don't want to get slaughtered being greedy. Okay, let's go back to our 2-day chart. We still have a couple more charts before we run out of time. We're going to go to TLT. What's going on there? That is the 20-year bond. It was down for the day, just barely at 0.17%. What do we see going on? Well, as we look closer at our 2-day chart, we see it pretty much sliding sideways. We had a crossover going up on the 2-hour chart, and we'll jump into that in just a minute. But what do we see going on the bigger chart, the 2-day chart? We see a sideways slide. We have not crossed over going down yet. Bonds are still sliding sideways at this point. Let's go to the next, to the biggest chart, the weekly. What do we see going on there? Derivative oscillator lost a lot of energy, but our MACD or our PPO is still moving up. We have a green so far during the course of the week. We have a green doji, lots of indecision still. Our PPO tells us we're still in an upward trend, so we shall watch and be careful. Now let's look at the 2-hour chart and see what it tells us. Well, it's interesting. Had some down movement at the beginning of the day, then up movement midday at noon and at 2, and then a bit of a spinning top toward the end of the day. We're still above the 2-day trend line as far as the 2-hour chart goes. We do see the derivative oscillator losing energy. We haven't had a crossover going down yet, although that could be coming, but we still have that weekly chart that's trying to give us some balance. So depending on where you got in, if you jumped in at the appropriate point at the opening at 119.40, it closed still above that at 120.16. So the high 120.36, and what are we looking for? Well, we don't want to lose money, but at the same time, if you've jumped in and you're on this pony, just continue to watch and see. If it turns way south on you, you can sure pull out and try not to have any losses. But at the same time, bonds appear to be positioned, according to our weekly chart, to move up. It's taking some time. It may or may not happen. So continue to see to it that you follow the correct trend. Okay, let's lastly go back to our 2-hour chart, 2-day chart, and we will take a look at gold. Gold up just barely 0.06%. It is below the 2-day trend line. It did crest below that. Still in an upward trend as far, well, it's really sliding sideways as far as the PPO goes. Derivative oscillator is losing energy. That's our 2-day chart. If we take a look at our weekly chart, we see that gold is not going up with the same force it had been before, and the derivative oscillator is holding steady, so keep an eye on gold. I mean, there's plenty of good reasons to go ahead and enjoy the profit that you have had since your jumping in point. Of course, if we go to our 2-hour chart, what do we see? We saw that indeed the jumping in point on gold on that 2-hour chart, got to backtrack a little bit to find it, it occurred at noon on the 30th of January. The opening was 113.49. Of course, gold up over $3 at 17.77, and that's a nice gain up to this point. Again, we have had the 2-hour chart rotate back over. Just look at gold as getting long in the tooth, and at some point you might want to go ahead, and take your profit or take part of it if you haven't already taken your profit. Remember, gold hit its highest high at 118.59 all the way back on the 8th of February. You don't have to stay in longer than you need to. Once we saw it lose that initial luster and crossover going down around the 9th, of course, it has not hit that high since then. Will it hit it again? Don't know, but don't stay in just to hit the high again. If you did not get out at the 118.59 point, do not tell yourself the foolishness that it has to hit that again for you to get out. You've still done extremely well if you got in at the right point at 113.49 all the way up to 117.77. What is that, $3 and a quarter? That's pretty darn good over less than a month. Folks, that's where we are as the end of the day on Tuesday, the 21st, as we go into Wednesday, the 22nd. Thank you so much for being with us. We always love to hear from you. You can write us CW at chartingwealth.com. We'll try to answer your emails, help in all the ways that we can. You want to help us out? Go to our iTunes channel. That is Charting Wealth at iTunes. Subscribe to our podcast. Give us a 5-star rating. Say something nice about us. If you don't already subscribe to our newsletter, man, you need to. You can get that at chartingwealth.com. It is completely free. What do you get with it? You get our How to Read a Stock Chart video. You get the layout that we use at freestockcharts.com. And you get our daily market worksheet. We've also done a new weekly market worksheet, and we're about to do a trader's worksheet so that you can keep up with your practice trades and really document that better. We'll get that stuff released to you soon, but you need to sign up for the newsletter. You'll get this video podcast every single day that the markets are open. God bless you. Take care from chartingwealth.com.